This year, there's only 4 companies putting gold mines into production, and we're one of them. And the other two are we're the only one in tier one jurisdictions left to go.
A year ago, basically January 2024 to May 2024, the gold miners index was not outperforming gold, at least not to the same extent. What's different this year? Recession risks are still around. The fears of a debt crisis looms. This is reflected in the gold price, but the gold price has been hitting a high of just close to $3,400 and hitting a ceiling there. What is next for not just the economy, but the price of gold? Shane Williams joins us today. He is the CEO of West Red Lake Gold, and we'll be talking about his outlook for the precious metal as well as his outlook for the mining sector. Shane's been pretty much spot on with his calls. You can check out his last interview with me, link down below. Shane, welcome back.
Excellent. Great to be back on, David. Great to be back on.
You've been calling for $3,000 an ounce for quite some time, and you've been right. And actually, the gold price since we spoke last a couple months ago at the VRIC Vancouver Resource Investment Conference has jumped up tremendously. So it's gone way past your gold price target. Additionally, good news coming out of your company this week brought the price up. On the 9th of May, it was trading at West Red Lake Gold shares were trading at 71 cents. Now it's above 78 cents. That's a 20% increase from its peak, from trough to peak, and then about a 12% increase factoring today's prices. So we'll talk about what happened there, but let's talk about gold first. So many people are still long-term bullish on gold despite the run-up. So here's an article from CNBC. We're in a good environment for gold. Our price target is $5,000, said Vanek. I think that's a longer-term forecast. But even David Einhorn, legendary fund manager, said that the price of gold still has more room to climb. More upside for inflation, more upside for gold. Gold is about the confidence in the fiscal policy and the monetary policy. And since we bought gold in 2008 or so, it's been very clear to me that the U.S. fiscal and monetary policies are both too aggressive and create a risk, he said. Others are a little bit more skeptical. There's a bullion dealer here quoted by the BBC that says that there's anxiety about which way the market is going to go next. And when you get these motions, ultimately it creates big trades, but this particular article was citing somebody who is warning against too much hype in gold. So lots of different mixed messages and forecasts out there. Where do you stand?
Yeah, look, I'm glad it's overshot our initial estimation for sure as a gold producer. So that's been very positive. Look, I see it a little bit different. I do see gold has had a big run up in the last 2 years, effectively, and for the first quarter of this year. Particularly the first quarter this year was driven by Trump and tariffs and sort of uncertainty around those. I do see as Trump begins to ease off, there will be a bit of consolidation in gold. Look, we've had a huge run up, and I do see a bit of a consolidation now for a period of time before another leg kick up. How long that would be? So probably over the summer. The summer months are never great for gold. It's normally a process, and I'd say probably a bit of consolidation now around this level. I don't see it dropping very much, but I do see a bit of a consolidation around this level. And then there is still recession risks in the US, as some people have said, inflation, recession risk. And then as that begins to kick in later in the year, I do see another lift of gold. So it's kind of a mix of both. I see a bit, but gold has run a lot. It needs to consolidate at some stage. We've never seen gold peak so quickly, so high, so fast.
You were calling for 3,000, not 3,500 or 4,000. It's run up to 3,400. Why do you think it surpassed even your very optimistic, bullish forecast?
Really, it was Trump. I do think that the whole Trump issues with tariffs, and as he came into being elected and as he put forward that agenda of tariffs, got in all those heavy tariffs, then pulled back on tariffs, still talking about tariffs. It's a lot of uncertainty, and gold is a key driver in uncertainty. When uncertainty, people go to gold. So that's kind of pushed gold well above overshoot those targets. But it has come down a little bit. It peaked at around 3,400 sort of number. Mm-hmm. It has come back down to that 3,200. Seems to be holding there, and I do expect it to hold around that level for the next while now as it consolidates.
Hypothetically speaking, let's take Vanek's $5,000 gold forecast. We're not putting a timeline on it, but what are the macro conditions that are necessary In other words, what needs to happen for $5,000 gold to be realized? And by the way, that's less than a $2,000 increase from here, which is about a 50%, 60% increase from here. Gold's run up more than 50% just in the last year.
Yeah, I would say basically two things really. Recession risks in the US. If we get into sort of bad numbers, the first quarter, we haven't seen the effects of those. There was a lot of uncertainty. I know some of the data is beginning to come in now on employment, early stage employment, trade, etc. I do see later in the year potential some recession risks. I think when that starts to kick in, people will again begin to think about gold and also potentially the stock market. The stock market has gone crazy. It's beginning to again taper off a little bit. So if that begins to have a bit of a crash, then I think they're the two catalysts in my mind for the next big lift up in gold.
Okay. You mentioned there's going to be a recession this year. Just, high level, what are some of the indicators that point to this forecast?
Yeah, so obviously, look, interest rates are still very high. There's normally
Yeah.
a lag with interest rates, because of mortgages and refinancings, et cetera, et cetera. And that takes some time to work through the economy. And so a lot of people are hurting now. Car loans, loans, credit cards, housing, and that's beginning to pinch. You see some of the data on credit card delinquencies, car payments, new car purchases, housing, that's all beginning to come down. And then unemployment is beginning to tick up. So they're indicators to me that something is undercurrent really in the market, and that will come through the economy, I think, as we get into the balance of this year.
Well, let's jump to the mining sector now. Before we talk about your company, I'd like to understand why the GDX has outperformed the gold price this year, and that wasn't the case last year. So let's take a look at my screen here. I'm going to pull up a gold price chart, and then we're going to overlay that with the miners. So this is gold year to date. It's up, a lot from $2,600 to $3,200 as we speak today. The GDX with the VanEck Gold Miners ETF on the same scale is up 37%, while gold is up 24%. If you were to take the same time frame a year ago, basically January 2024 to May 2024, the gold miners index was not outperforming gold, at least not to the same extent. What's different this year?
Yeah, so this is normally, if you look back over the last number of years in gold and the miners, in the last big run up, which was 2011, 12, this is kind of typical. Gold runs first, right? The price of gold runs up, but it does take a lag before the miners begin to get in. And I think it's around people try to understand, is this a long-term trend on gold or not? Because, gold miners, cash flows begin to generate huge cash flows. I've seen the last couple of quarters, if some of your listeners and viewers have seen, if you look at the quarterly results of the majors, the big gold mine, they are generating massive cash flows. And so as that begins to come transparent a couple of quarters later or a lag, then you'll see huge inroads of capital to those as they're beginning to come in. So it's just a lag effect that happens. And then usually as the market comes in, the market is very small for gold miners and junior gold miners. So as money begins to come in, it's kind of like a spout, money going into a big funnel, into a spout. That just drives a lot of value into those miners. And you can see it rises up fairly quickly and often overshoots the
Yeah.
gold market as well. So that's what we're seeing this year in particular. As you said, if you went back last year or the last 2 years, you wouldn't see that effect. But you can see it
Yeah.
there. If you
It
go back,
underperformed last year.
underperformed basically, then suddenly this year, basically it's had that effect where it's just all began to tick in.
And also,
That's just a timing effect, yeah.
yeah, the GDXJ, which is the purple line, is the junior index, and that's
Yeah.
performing online with the seniors in terms of their stock price valuations. I'm going to overlay this with a Russell now, and you can see that the Russell has even small cap companies, small and mid cap companies in the US have significantly underperformed gold stocks. So it's not like people are rushing into gold stocks because everyone was rushing into small caps and equities this year. In fact, the opposite happened. Same thing with the S&P 500. So it's very clear that the gold miners were following the gold price and not following the overall stock market. Um, are you surprised by this trend?
No, not really. As a gold miner ourselves, and I worked in the industry for a long time, the leverage to gold price from a gold miner is huge because a lot of the gold producing of mine is relatively fixed in the industry. You know, the AISCs they're up quite a bit, but the difference, the margin is growing in as gold price rises now. And some of those big gold miners are generating massive margins. And with that comes massive cash flow. And that's what you're seeing in the
Yeah.
last, when it run up quickly, it takes a while. It takes a lag effect. It takes a couple of quarters. It takes half a year. But then it begins to really, once people see that that's kind of the new norm, then they start to look at the miners and start to see the sort of profits and free cash flow they're generating. And that's where you get the big move of the institutions and the money managers into that.
There's been a debate as to how the gold miners would move if, let's say, the overall stock market sells off. And people have wondered, well, if gold goes up when stocks go down, would miners follow gold or would miners follow the equities markets? And I think this year has proven that, at least for this year, at least, the miners would follow the gold price. So, what is the industry doing about this renewed optimism? What are you seeing, at least the seniors, and we'll talk about the juniors just a bit, but at least with the seniors, what are they doing with this free cash flow that you're talking about, this really high level of free cash flow?
Well, we are seeing up to now, actually, back in the last big boom in 2010, 11, there was a lot of free cash flow. We did see a lot of M&A activity, a lot of M&A activity. A lot of it was kind of just M&A for the sake of M&A. We have seen very strategic M&A. They're holding on to that cash flow. They're providing it, sending it back to shareholders, being much more cautious with that cash flow. And they are beginning to start to make M&A. There is a bit of M&A activity going on, but it is much more tapered, and it's much more, in my view, it's much more um, clever and much more strategic sort of M&A rather than that. Now, as the market goes on and these cash flows continue, the gold mining industry is funny. It's a depreciating business. Your asset is always depreciating. As you mine more, you need to add more all the time. So you need to add ounces. So you do need to buy, grow, develop all the time. So that's the nature of the business. So I do see that that's beginning to start and beginning to trickle down.
M&A, is that picking up?
Yeah, M&A, yeah. It is picking up. It definitely is picking up. As you're aware, Newmont obviously had a number of big asset sales last year and earlier this year, and they got huge money for their assets, well above what they expected when they did the full plan of what they wanted to achieve. They way overtopped what they wanted to get. A lot of it was in cash and value. And there's a couple of other big majors putting their assets on the table now. So people are beginning to definitely look at other alternatives, other assets, grow their businesses.
How is this impacting West Red Lake Gold? I mean, the rise in the share value for miners as well as a rise in gold. You're transitioning between a discovery company into a producing company. So this isn't you're kind of on the line here, right? I don't think you've received free cash flow for production yet. Am I correct?
Yeah, we have received cash flow. We have produced around 3,000 ounces so
Okay.
far. So we're just starting that process. And the key advantage of starting a gold mine in this sort of environment is you're getting cash flows to help you ramp up considerably more. If gold was in the $2,000 environment, you are getting a much bigger cash flows for smaller production to allow you to ramp up very quickly. That's the advantage of the transition at this stage. A lot of investors are looking for projects that we have a lot of leverage to gold price because we move from a developer to a cash flow producer. So then you get that leverage, you get that uptick in share price, and it can run very leverage, which you don't get with the big producers. They move up, they get free cash flow, but the smaller companies, you get a lot of leverage from that moving into cash flow.
Shane, let's talk about your company specifically. So West Red Lake Gold, like I said, up a lot this year, and I'll put up the chart while you explain what happened this week.
Yeah, so this week was very significant for the company in a couple of different areas. So we as a group have been working on, as some of your listeners may be aware, we bought an asset called a Madsen asset. It was a mine that we bought out of bankruptcy effectively. And we've been working for like the last 2 years on de-risking that. And we had just late last week, we had some exciting results where we ran a bulk sample program and we test mined a number of areas of the mine. And then we put it through the mill, had some gold, and we did a full reconciliation to make sure that the mine and the mill and everything was working together. And we published those results last week. And they're kind of the last de-risking stages from my perspective that we need to do to be ready to move back into full production. So they were very significant. So the market responded well, as you can see that there in the green just from last week in May. We had a very big kick up well above 85 cents. And we also had another significant, a couple of drill hole results. We're finding as we go into the deposit and get deeper and grow the deposit, we're finding that it gets more higher grade and more continuous. So the combination of those two results, catalysts over the last 2 weeks, has really pushed the share price up to where well above where we expected to be towards this year.
Well, share prices usually move on beating expectations. So how do you think that the results of these drill results, how did they beat company expectations and also investor expectations?
Yeah, really well. Two things. The bulk sample results they were the last tick that we had talked about for 12 months. Mm-hmm. We needed to move straight back into full production. So with those behind us, we're in a position now to really ramp up the mine to full production balance of the year. So people, respond well to that. We're generating free cash flow. The share price will grow with that. And with the drill results, which were close to the surface of those samples that were close to those areas, they translate immediately into higher grade and bigger tons material into the mill. So the combination of those people see that as very positive to move the project and ramp it up into full free cash flow.
Okay. What's next for West Red Lake Gold?
So West Red Lake Gold now, we've done a de-risking. We have restarted the mill as we speak. And between now and the middle of the year, it's really ramp up to commercial production. That's really the focus for the balance of the year, to ramp the project back up and get it to full production rate by the back end of this year.
I think investors are concerned about whether or not you're expanding at a fast enough rate, given that you're now transitioning into a producing company. I think some people may be asking, well, how do we add shareholder value if we're going to start producing rather than expanding deposits?
Yeah, so the strategy of this company was always to grow. Mm-hmm. The Madsen was a first preference of a first target that we turned quickly. Remember, like the company we only bought the asset 2 years ago. So we've gone within 2 years from a start of the company to fully cash flow, which is a very fast track approach to building a mining company. And so the idea would be over the next number of years, we would buy other assets and grow the company very quickly and scale the business.
The mining industry now, what do you think is going to happen now with people who have been talking about peak gold for quite some time? And I know this is not a recent development, but I've been talking to some miners and they've been telling me that gold is now harder to extract than ever. Their all-in sustaining costs could go up. Is this something that you're kind of envisioning as a challenge for a producer going forward?
Yeah, there's a lot of for gold miners in particular. And miners in general. As you're probably aware, it can take 10 years to put a mine into production now. There's permitting challenges, there's people issues, there's costs are rising, people are hard to find. So there are cost challenges associated with building and operating mines. And there hasn't been a lot of big gold mines built over the last 5 to 7 years. The gold market has been down a little bit. So I do see a limit to the supply that's available as they grow. So, the big producers keep having to grow. So there's limited companies. As an example, David, this year, there's only 4 companies putting gold mines into production, and we're one of them. And the other 2 we're the only one in tier 1 jurisdictions left to go. Ascot or Artemis was one of them. That's gone into production earlier this year. we're the only other one in Canada that's putting a gold mine into production this year. So, there's other ones in different parts of the world, but from a tier one jurisdiction, we're the only company putting a gold mine into production this year.
Very good. So we'll follow up your journey and your next steps. Shane, where can we learn more from your company in the meantime?
So westredlakegold.com is the website, and we've a lot of good interviews, corporate presentation, a lot of details around the company there. A lot of media, people can see the scale of the operation, the infrastructure we have, the production. So that's the place to follow us, David. They can sign up on the investor page as well and get regular updates.
Okay. We'll put the links down below, so make sure to follow West Red Lake Gold there. Thank you very much, Shane. Good luck with the next steps. We'll follow up soon.
Thank you very much, David. Thank you.
Thank you for watching. Don't forget to like and subscribe.